Welcome to the deep dive. Today, we're jumping straight into a structure that really shook things up in European alternative investments. The Reserved Alternative Investment Fund, the RAIF, our mission today, to basically give you the strategic roadmap for this vehicle. It was set up in Luxembourg, back in July 2016?
That's right, 2016.
And what we're looking at is this, innovative piece of legislation. It really cemented Luxembourg's place as a super attractive hub for alternative funds globally.
Absolutely.
The whole appeal seems to hang on three main things: huge flexibility in how you structure it, way less red tape, and what everyone loves, getting funds to market faster, speed.
Exactly. That time to market is crucial.
Now, here's the interesting part, maybe the bit that makes people lean in. The RAIF is technically an alternative investment fund, an AIF, but the fund itself, the vehicle, is explicitly unregulated by the SCSp, Luxembourg's financial authority. So how does that work? Alternative, but unregulated. It sounds a bit, contradictory.
Yeah, it does seem that way at first glance, but it's actually the core design, you could say the genius, of the RAIF. It uses this concept, you might call it, regulation by proxy.
Okay.
So yes, it is an AIF. It follows the principles of the AIFM law from 2013. But crucially, the fund vehicle itself, it doesn't have that direct prudential oversight you'd find with, say, a traditional regulated fund in Luxembourg, like the SEF.
To SEF being the Specialized Investment Fund.
Precisely. And that lack of direct fund oversight is what gives it the speed. It's a massive competitive edge.
Okay, let's quickly unpack that AIF classification then. If we sort of cut through the legal jargon, what does a fund actually need to do or be to count as an AIF?
Right, it boils down to two main things, functionally speaking. First, it has to be a collective investment undertaking.
Yeah.
So it pulls capital from various investors.
Multiple investors. Yeah.
Invests is based on a defined policy, for their shared benefit. Standard fund stuff. Second, and this is the key legal distinction, it must be specifically defined as not being a UCITES fund, the retail funds.
Yeah.
That exemption basically confirms its alternative status and sets it up for these specialized RAIF rules.
Got it. So non-UCITES, collective investment. If it ticks those boxes, we get to the speed you mentioned. The fund launch doesn't need a green light from the CSSF. What does that actually look like in practice for someone setting up a RAIF?
Well, it means they can basically incorporate and launch much, much faster. Think about the usual process, submitting documents, waiting for regulatory approval. It takes time.
Weeks, months sometimes.
Easily. With the RAF, there's no CSSF pre-approval needed for the fund itself. But it's not just the launch. The real kicker is the ongoing flexibility. Making changes later on, say, tweaking the investment strategy, adding a new sub-fund, or even deciding to wind it down. None of that needs prior clearance from the CSSF either.
Wow, okay.
This massively cuts down that time to market, or T2M as people call it. In the fund world, speed is often everything.
That must have really shifted the landscape, especially thinking about the SIF, the Specialized Investment Fund. That was the go-to alternative structure in Luxembourg before the RAF, wasn't it?
Absolutely. The SIF was, and still is, a solid vehicle, but it requires both initial authorization and continuous direct supervision by the CSSF.
So more paperwork, more oversight, slower processes.
Exactly. That means longer launch times, potentially higher setup and running costs. The RAF just sidesteps that need for direct CSF supervision of the fund vehicle itself. That makes it way more agile, much more efficient, especially for managers and investors who want to deploy capital quickly.
Which brings us to maybe the billion-dollar question here. If the fund vehicle isn't directly regulated by the CSSF, who's making sure everything's above board, where does the actual oversight come in? Is it just, regulatory light?
That's the clever part.
Yeah.
It's not about avoiding regulation. It's about where the regulation is applied. There are very strict guardrails.
Okay, good.
The rule is crystal clear. The management of the RAF's assets must exclusively be handed over to an external alternative investment fund manager, the AIFM.
So the regulatory focus shifts entirely. It's not the fund structure, it's the operator, the manager.
Precisely. And that AIFM isn't just any manager. It must be properly authorized, usually by the CSSF if it's Luxembourg-based, or by another competent EU authority if it's elsewhere in the EU, or even a recognized third country.
So a fully regulated entity.
Fully regulated, yes, and fully compliant with the pretty demanding AIFM directive. That means they're responsible for all the crucial stuff: portfolio management, risk management, compliance, the works. Think of it like this. You regulate the highly skilled pilot, not the specific jet they're flying. The jet can be fast and specialized because the pilot is licensed, vetted, and constantly monitored.
That makes sense. So because you're relying so heavily on this regulated AIFM, it follows that the RAF isn't exactly going to be marketed down the local high street, right? It's not for everyone.
Definitely not. RAIFs are strictly reserved for what the law calls well-informed investors.
And who qualifies under that definition?
Typically, this means institutional investors, like pension funds or insurance companies, professional investors, as defined under MiFID, or, interestingly, other investors who might not automatically qualify but can provide a written statement confirming they understand the risks involved and meet certain criteria.
Right. They need to attest to their sophistication. And isn't there also a fairly hefty financial barrier to entry? A minimum investment?
Yes, there is. To ensure that investors truly are well-informed or can bear the risks, they generally need to commit a minimum of EUR 125,000 to the RAIF.
Okay, 125K, that's a significant threshold.
It is. It acts as a simple proxy for sophistication.
Yeah.
But there's an alternative route if someone doesn't meet that specific amount.
Oh.
They can still invest if they get an assessment from a credit institution, an investment firm, a management company, or even the AIFM managing the RAIF itself. That assessment needs to certify their expertise, their experience, and their knowledge to adequately appraise an investment in the RAIF.
So either put up the cash or prove you know what you're doing through an expert evaluation. It's a solid gatekeeping mechanism.
Exactly. It maintains that focus on sophisticated capital. Now, connecting back to that speed and flexibility idea, it's worth looking at the actual legal forms the RAI can take. It's not just one type of box.
Right. Initiators have choices. What are the main options?
Broadly, there are two main paths. You can go the contractual route, which is the Funds Common Placement, or FCP. That's basically an unincorporated pool of assets managed by a separate management company.
Okay, the FCP.
Or you can use a corporate structure.
Mm-hmm.
This can be a company with fixed capital, known as a SICAF, or variable capital, the much more common SICAF.
And within that corporate structure, there's more variety.
Oh, yes, quite a bit. You can use familiar forms like a public limited company, the SA, or a private limited liability company, the RRL. There's also the cooperative company structure, SCSA. And importantly, for alternative assets, you have partnership structures available, the partnership limited by shares, SCA, the common limited partnership, SCS, and the very popular special limited partnership, the SCSp.
So a whole toolkit of legal forms.
Exactly. The key point is that Luxembourg offers pretty much the full spectrum of recognized legal structures. This means the RAF can be tailored very precisely to fit the specific needs, tax considerations, and preferences of the investors and the strategy.
That flexibility is powerful. And speaking of flexibility, let's talk assets. You mentioned it's an alternative investment fund. How alternative can the investments actually get? What if someone listening is thinking about, I don't know, vintage cars or fine wine?
Well, this is one of the really striking features. Because the RAF itself isn't subject to direct product regulation by the CSSF, there are very few specific restrictions on the types of assets it can hold.
So wine, art, diamonds, even crypto assets, perhaps.
Potentially, yes. The framework allows for investment in a very broad range of assets, including things you might call unconventional or non-financial assets like wine, art, or diamonds. If you're setting up a specialized fund focusing on these niches, the RAI structure doesn't inherently block you, unlike some more traditional fund types.
That's quite remarkable freedom. But is it a total free-for-all? Are there no limits on concentration or risk?
Not quite a free-for-all. While asset eligibility is broad, the RAI, by default, inherits some important risk diversification rules. These generally come from the regime governing the SAF, the Specialized Investment Fund.
Okay, so there's a baseline level of prudence baked in, even with the operational speed.
Correct. It ensures some risk spreading unless you deliberately opt out via the tax regime, which is a whole other choice.
Okay, so what are those default diversification limits someone setting up a standard RAIF needs to remember?
The main one, coming from the SIF rules via CSSF Circular 07309, is a concentration limit. Generally, a RAIF can invest no more than 30% of its total assets or commitments into securities of the same kind issued by the same entity.
30% cap per issuer?
Yes. And similarly, if the fund engages in short selling, the resulting short exposure to securities of the same type from the same issuer is also typically capped at 30% of the fund's asset value. These rules help ensure investors aren't overly exposed to a single counterparty or asset unless
They choose the other path. This brings us neatly to the tax side, which seems like a really critical decision point for RAIF initiators. It's not just about tax rates, is it? It's a fundamental choice affecting investment strategy.
Exactly. When you set up a RAIF, you have to make a crucial election regarding its tax and, consequently, its risk diversification regime. You essentially choose one of two paths.
What's the first option, the one that likely links to those diversification rules we just discussed?
That's opting to operate under the SIF tax regime. If RAF goes this route, it gets the exact same tax treatment as a SIF, which is very advantageous.
Wow, advantageous.
It's only liable for an annual subscription tax, the taxe d'abonnement, currently set at just 0.01% of its net asset value. That's incredibly low.
Wow, 0.01%. That's minimal.
It's very tax efficient. But, and this is the crucial trade-off, if you choose this SIF tax regime, you must comply with those risk diversification rules, the 30% limits we talked about. You get tax efficiency, but you accept investment concentration limits.
Okay, efficiency with diversification constraints. What's the alternative path then? The SICAR regime.
Right. The second option is to subject the RAIF to the tax regime applicable to SICARs. That stands for Société d'Investissement en Capital à Risque, or Risk Capital Investment Company.
Risk capital. That sounds geared towards specific strategies.
It absolutely is. Choosing the SICAR regime explicitly targets funds focused on high-risk, often concentrated investments like classic private equity or venture capital deals. Strategically, it's a very different animal.
And the tax treatment reflects that difference.
It does. If you opt for the SICAR regime, the RAIF becomes subject to Luxembourg's standard corporate income tax. The rate is currently around 23.87%, significantly higher than the 0.01% subscription tax.
Okay, much higher tax rate. Why would anyone choose that? What's the upside?
The massive upside, the reason you accept the higher tax rate, is investment freedom. A RAIF under the SICAR regime is not subject to any statutory risk diversification rules.
Ah, complete freedom from concentration limits.
Exactly. It allows for totally unrestricted investments in target companies, which is often essential for PE and VC strategies where you might take a very large stake in a single portfolio company. Plus, the SICAR regime brings other tax benefits relevant to risk capital investing.
Such as?
Well, income derived from the risk capital assets may be exempt from corporate income tax under certain conditions. Also, RAIFs under the SICAR regime are typically exempt from Luxembourg's net wealth tax, and dividend distributions they make are generally exempt from withholding tax. They can also potentially benefit from Luxembourg's extensive network of double tax treaties and the participation exemption rules.
So it's a tailored package, higher standard tax rate, but total investment freedom and specific exemptions suited for PEVC returns, a specialized tool.
Precisely. It creates this sort of regulatory and tax haven specifically for risk capital funds that need that freedom from diversification rules.
And just quickly, one administrative point that applies regardless of the choice, the VAT treatment of management fees.
Yes, that's a nice practical benefit. Management services provided to the RAIF by its external AIFM are exempt from VAT in Luxembourg. That applies whether it's under the SIF or SICAR tax regime. It simplifies things and reduces costs a bit further.
Okay, so we have this structure. Regulated manager, flexible fund vehicle, choice of tax risk regimes. If we zoom out, what has the RAIF done for Luxembourg's overall position in the global fund landscape?
I think it's been hugely significant. It really combines Luxembourg's traditional strengths, its deep expertise in asset servicing, its stable legal environment, its experienced regulator for the manager, with this new layer of speed and flexibility for the fund.
Making it more competitive.
Definitely. It reinforces Luxembourg's reputation as a premier, maybe the premier global hub for alternative investment funds. Because it's so flexible structurally and in terms of assets, it works well for pretty much all the major alternative strategies. Private equity, real estate, hedge funds, infrastructure, venture capital. All benefiting from that faster time to market.
But arguably the killer feature, the thing that really gives it an edge across Europe, must be the European passport, right?
Oh, absolutely. That's probably the single biggest competitive advantage because the manager, the AIFM, is fully regulated under the EU's AIFM directive.
The directive we mentioned earlier.
The RAIF itself benefits from the European marketing passport associated with that directive.
And what does that mean practically for the fund manager?
It means they can market the RAIF directly to eligible, well-informed investors across all 27 member states of the European Union, using a relatively simple notification process managed by the AIFM's home regulator.
So no need to get separate approvals or navigate complex local private placement rules in potentially dozens of different countries.
Exactly. It eliminates those often cumbersome, time-consuming, and expensive preliminary procedures in each individual country you want to market in. This massively expands the fund's potential investor base and makes cross-border fundraising far more efficient. It's a huge facilitator for reaching capital across the EU.
That's a game changer. So, okay, stepping back. The fund itself isn't directly watched by the CSSF, but we have the heavily regulated AIFM providing the core oversight of investment and risk. And you also mentioned mandatory service providers. They add another layer of checks and balances on the operational side.
Yes, that's the final piece of the regulation by proxy puzzle. Every RAI is required to appoint certain key service providers based in Luxembourg.
Who are they?
First, a depository bank. This bank must either be established in Luxembourg or be a Luxembourg branch of an EU credit institution. Its job is safekeeping the assets and oversight duties.
Custody and oversight. Crucial.
Very. Second, the RAI must have its central administration located in Luxembourg. That means the core administrative functions, accounting, NAV calculation, register keeping happen there.
Keeping the operational hub local.
Right. And third, every RAIF must appoint an independent approved external auditor, a réviseur d'entreprise agréé. They audit the annual accounts.
So depository, central admin, auditor, all mandatory, all Luxembourg-based or supervised.
Correct. These appointments ensure that even without direct SCSp supervision of the fund vehicle, there's robust, independent oversight of asset custody, valuation, operations, and financial reporting. It completes that structure of indirect supervision and maintains market integrity. So if we, try to wrap this all up, the RAIF structure is really quite an ingenious solution, wouldn't you say? It manages to leverage the very strict, harmonized EU regulation that applies to the manager, the AIFM.
Right, the pilot.
To enable the creation of a very swift, flexible, market-ready investment vehicle, the fund itself.
Right.
But critically, it's a vehicle aimed squarely and solely at sophisticated, well-informed investors who are deemed capable of understanding the specific risks involved, including the lack of direct fund supervision. It finds that balance between speed and integrity.
It really does seem like a carefully engineered balance. And that brings us perfectly to a final thought for you, our listeners, something to maybe mull over about how regulation and transparency interact. Remember, we said the RAI is explicitly unregulated by the CSSF. Well, the RAIF's prospectus, its main issuing document, is legally required to state that fact very clearly. It must explicitly declare that the RAIF is exempt from prudential supervision in Luxembourg. So the question for you is, why mandate making that lack of direct supervision so explicit? How does forcing the fund to advertise its unregulated status actually serve both the fund manager, who wants that speed and flexibility, and the well-informed investor, the one putting up at least EUR 125,000? Think about it. In this structure, is transparency about the absence of regulation itself a form of mandated investor protection? Something to consider.